So you've set out on your journey on this beautiful open water full of opportunities. Great winds and calm seas ideal for sailing, just perfect conditions. That didn't sound good. And now you're fighting just to stay upright, cold, scared, and clinging to your mast. This was not the plan. Maybe you needed oars as well. How could you know? Maybe you couldn't have. You need someone with experience out here, the guidance to help you navigate and the tools necessary for the journey. Welcome to Sailing and Rowing Interactive. Have recent financial conditions and shifting economic winds left you uncertain and full of questions? Are you wondering if your current strategy is still working? Maybe your perspective has changed on your entire financial situation. Or maybe you are realizing things can get choppier than you once thought. Investing can be difficult. We are here to help. You have probably heard of bull and bear markets, periods of steady growth or decline, but you may not know that these markets can be both short and long-term. Long-term bull and bear markets are called secular markets and can last for well over a decade. On the other hand, short-term bull and bear markets are called cyclical markets and are much shorter in nature, sometimes lasting for just a year or two. During your financial journey, it is important to understand and appreciate how these different market types may affect not only your investment strategy, but also your investing experiences. To help you make sense of it all, we would like to share a simple yet powerful metaphor called sailing and rowing. Sailing markets represent bull markets, when market winds are at your back and the waters are calm. In these markets, you may want to raise your sails as high and wide as possible in order to capture as much of the market wind as possible. But conditions change. Market winds can turn and the waters can grow rough. Turbulent and unpredictable currents can push you off course. These bear market periods may leave doubt and uncertainty in their wake. Situations like this may require the ability to row, to use quick maneuvering to stay on course. Hence, bear markets may be considered rowing markets. Unfortunately, it is often difficult to determine what market conditions lie ahead. When you look at the Dow Jones Industrial Average since 1906, it might look like a steady sail to prosperity. It might seem to make sense to only set sail with an asset allocation approach designed to capture the long-term market winds. But on a closer look, you can see that this period is full of secular bull and bear markets that may have required both sailing and rowing to navigate. And to make navigating even more challenging, each of these secular long-term periods have been made up of shorter cyclical bull and bear markets. They can be the false calm at the eye of a hurricane, or the chance to make up for lost time during a period of otherwise rough waters. Each market, bull or bear, long or short term, presents unique opportunities and challenges. Understanding the characteristics of each of these secular periods may help you better prepare for your own financial journey. In addition to affecting your actual outcomes, secular and cyclical markets may also influence your decision-making process. Let's take a look at how secular and cyclical markets might influence your experiences. Paul was born in 1918. In his life, he witnessed the Great Depression and World War II. Reaching his prime investing years in 1966, he quickly realized that the markets could be very turbulent, which led him to be very conservative. But when Paul retired in 1983, he did so at the start of a great bull market. Even though his investing was conservative, the strong market winds helped him grow his wealth even in retirement. Pam was born in 1942. She too had seen market swings, though not to the same degree that Paul did. She began investing in 1987 at age 45, during the same soaring bull market Paul retired into. She spread her investment sails high and wide and intended to ride the momentum all the way to retirement. After all, the wind had been blowing in her favor since 1987. Why would it change? But when the time came to retire in 2004 at age 62, a volatile market environment left her uncertain, scared, and doubtful in her ability to have a comfortable retirement. Clinging to her sailing strategy, the next few years of extreme market ups and downs only perpetuated her sense of fear and panic at a time that should have been about confidence and security. Both Paul and Pam's investment philosophies and results were greatly influenced by the long-term market periods they experienced during their lifetime. Due to these experiences, they formed very different perspectives on the market and had vastly different results. For investors using a strategy designed for the sailing market of the 1990s, the past decade may have left them emotionally drained and adrift at sea. For others, the turbulent experiences of the past decade have left them wanting off the seas entirely. As market conditions change, clinging to a single approach to asset allocation may not be ideal. You may want a strategy that utilizes both sailing and rowing approaches. What is your approach to asset allocation? Are you sailing or rowing? Do you know? For some, diversification is not just about spreading your portfolio between stocks and bonds, but also about employing multiple approaches to asset allocation. Sometimes you may need to sail more, and other times row. There are 4 approaches to asset allocations one might consider when constructing an investment portfolio. Let's take a look at them. 2 approaches are designed for sailing markets, when you want to cast your sails wide and capture the market winds. They are strategic and tactical constrained. 2 approaches are designed for rowing markets, when you feel the need to maneuver to avoid risk and react quickly to volatile waters. They are tactical unconstrained and absolute return. As the waters are constantly changing, a diversified mix of approaches may help provide you with the tools necessary to progress and adapt in any market environment. Let's look at the characteristics of each approach. If we look back to our 2 previous case studies, we can now better appreciate the opportunities they had to sail and row. Paul began investing in 1966, the start of a significant secular bear market. Due to the characteristics of this period, it may have been a great time to overweight his asset allocation mix toward rowing strategies. On the other hand, Pam began her investing journey at the start of a great bull market, a time when tilting her approach towards sailing strategies might have helped her to better capture the force of the market winds. Does your current portfolio employ both sailing and rowing strategies? Could diversifying your approaches to asset allocation help to create more stability on your financial voyage? Do you have access to the tools and guidance necessary to make confident investment decisions? We are here to discuss these and other questions with you. Thank you for taking a few minutes to learn about this unique perspective on wealth management.